After studying this module, one shall be able to know about the constant purchasing power model, know about the cost accounting model, understand the capital maintenance in the units of constant purchasing power model, know about the requirements of IFRS. Introduction: 3 basic accounting models. International Financial Reporting Standards (IFRS) are proposed as a communal global language for certified dealings so that enterprise accounts are reasonable and similar through international margins. They are a significance of rising worldwide shareholding and trade and are generally important for corporations that have relations in several countries. They are increasingly swapping the many dissimilar national accounting standards. The instructions to be trailed by accountants to retain books of accounts which is similar, reasonable, dependable and relevant as per the user's internal or external. IFRS initiated as an endeavor to correspond accounting across the European Union, but the value of the harmonization rapidly made the idea attractive round the world. They are the time to time still called by the original name of International Accounting Standards IAS. IAS were bounded by 1973 and 2001 by the Board of International Accounting Standards Committee IASC. On April 1, 2001, the original International Accounting Standards Board held above from the IASC the accountability for setting international accounting standards. Objectives of the financial statements. A financial statement must imitate a true and fair opinion of the profitable affairs of the association. IFRS authorize 3 basic accounting models. First, current cost accounting. Beneath physical capital maintenance at all levels of inflation and deflation, beneath the historical cost paradigm as well as the capital maintenance in the units of the constant purchasing power paradigm. Second, financial capital maintenance in the nominal monetary units, that is, globally applied historical cost accounting through low inflation and deflation only beneath the traditional historical cost paradigm. Third, the financial capital maintenance in the units of the constant purchasing power CMU CPP in the daily terms of daily consumer price index or daily rate at all levels of inflation and deflation beneath the capital maintenance in the units of the constant purchasing power paradigm. The following are the 3 underlying assumptions in IFRS. First, going concern. An article will endure for the anticipatable future under the historical cost model as well as under the capital maintenance in the units of the constant purchasing power model. Second, stable measuring unit assumption. Financial capital maintenance in nominal monetary units or traditional history cost accounting only under the traditional history cost paradigm, that is, accountants considered changes in the purchasing power of the functional currency up to but excluding 26% per annum of 3 years in a row, which would be 100% cumulative inflation over 3 years or hyperinflation as defined in IAS 29, as immaterial or not sufficiently important for them to choose capital maintenance in the units of the constant purchasing power in terms of the daily consumer price index or daily rate capital maintenance in the units of constant purchasing power at all levels of inflation and deflation as authorized in IFRS in the original framework 1989. Accountants implementing the stable measuring unit assumption, traditional historical cost accounting during annual inflation of 25% for 3 years in a row would erode 100% of the real value of all the constant real value non-monetary items not maintained constant under the historical cost paradigm. Third, unit of constant purchasing power. Capital maintenance in the units of constant purchasing power at all levels of inflation and deflation, including during hyperinflation as required in IAS 29 in terms of daily consumer price index or daily rate only under the capital maintenance in the units of the constant purchasing power paradigm, that is, the rejection of the stable measuring unit assumption at all levels of inflation and deflation. Capital maintenance in the units of the constant purchasing power in terms of the daily consumer price index or daily rate at all the constant real value non-monetary items in all entities that at least break even in real value at all levels of inflation and deflation, ceteris paribus. Remedies for an indefinite period of time the erosion caused by the historical cost accounting of the real values of the constant real value non-monetary items never maintained constant as a result of implementation of the stable measuring unit assumption at all levels of inflation and deflation under HCA. It is not inflation doing the corroding. Inflation and deflation have no consequence on the real value of the non-monetary articles. It is the enactment of the stable determining unit assumption, that is, traditional HCA, which erodes the real value of the continual real value non-monetary items never sustained continuous in a double entry simple accounting model. Constant real value non-monetary items are non-monetary articles with continual real standards over time whose value within an entity are not usually determined in a marketplace on day-to-day basis. All continual real value non-monetary articles are constantly and universally measured in the units of continual purchasing power at all levels of inflation, including during hyperinflation and deflation beneath CMU CPP in terms of daily CPI or daily rate under the capital maintenance in the units of the constant purchasing power paradigm. The constant purchasing power gain or loss is planned while current period continual items are not measured in the units of the constant purchasing power. Monetary items constitute the money supply. Historic and current period monetary items are required to be inflation adjusted on the daily basis in terms of a daily index or rate under the capital maintenance in the units of the constant purchasing power paradigm. The net monetary loss or gain, as well defined in IAS 29, is essential to be considered and accounted when they are not inflation adjusted on a day-to-day source through the present financial period. Inflation adjusting the total money supply, excluding banknotes and coins of the fiat functional currency created by means of the fractional reserve banking within an economy, in terms of a daily index or rate under the complete coordination would result in zero cost of inflation or not zero inflation in only the entire money supply as qualified in an economy. Variable real value non-monetary items are non-monetary items with the variable real value over time. Examples include quoted and unquoted shares, property, plant, equipment, inventory, intellectual property, goodwill, foreign exchange, finished goods, raw material, etc. Current period variable real value non-monetary items are required to be measured on the daily basis in terms of IFRS, excluding the stable measuring unit assumption under the capital maintenance in the units of the constant purchasing power paradigm. When they are not valued on the daily basis, then they as well as historical value, real value or non-monetary items are required to be updated daily in terms of a daily rate as indicative above. Current period impairment losses in variable real value non-monetary items are required to be treated in terms of IFRS. They are constant real value non-monetary items. Once they are accounted, all the accounted losses and profit are constant real value non-monetary items. Under the capital maintenance in the units of the constant purchasing power paradigm, day-to-day dimension is required of all items in terms of A. A daily consumer price index or monetized daily index unit of account through low inflation, high inflation and deflation. B. In terms of somewhat steady foreign currency equivalent amount, generally the US dollar daily equivalent rate. Daily index throughout the hyperinflation. Hyperinflation. Hyperinflation is defined in IAS 29 as collective inflation equal to or eminent 100% over 3 years, that is 26% annual inflation for 3 existences in a row. Qualitative features of the financial proclamations. Qualitative features of the financial proclamations comprise relevance, materiality, faithful representation. Enhancing qualitative characteristics include understandability. Elements of the financial statements IAS 1, Article 10. The financial position of an enterprise is primarily provided in the statement of the financial position. The elements include assets, liability, equity, constant purchasing power model. Equity is the constant real value of the shareholders' equity. The financial presentation of an enterprise is mainly providing in the statement of the comprehensive income statement or profit and loss account. The components of an income proclamation or the components that extend the financial presentation are as follows. Revenues. Revenue rises in the economic advantages during an accounting period in the form of inflows or enhancement of assets or decrease of liabilities that results in increases in equity. However, it does not include the contribution made in the equity participants, that is, proprietors, partners and shareholders. Expenses. Expenses decreases in the financial benefits during an accounting period in the form of expenditures or depletion of the assets or in the currencies of the liabilities that results in the declines in the equity. Revenues and expenses are measured in the nominal monetary units under the historical cost accounting model and in the units of the constant purchasing power, inflation adjusted under the units of the constant purchasing power model. Statement of the changes in the equity. An article is accepted in the financial statements when it is probable future economic benefit will flow to or after an entity. The resource can be reliably measured, otherwise the stable measuring unit assumption is applied under the historical cost accounting model. That is, it is assumed that the monetary unit of the account, the functional currency, is perfectly stable, zero inflation or deflation. It is simply assumed that there is no inflation or deflation perpetual and the articles are specified at the original insignificant under the capital maintenance in the units of the constant purchasing power model. All constant real value non-monetary items are restrained in the units of the continual purchasing power in terms of a daily index at all levels of inflation and deflation. That is, all items in the statement of the comprehensive income, all items in the shareholders' equity, account receivable, accounts payable, all monetary payables and all monetary receivables provisions, etc. Measurement is the procedure of defining the monetary amounts at which the basics of the financial statements are to be acknowledged and approved in the balance sheet and income statement. This includes the collection of the specific base of measurement. A number of dissimilar quantity bases are working to the different units and in varying arrangement in the financial statements. They include the following. Historical cost. Assets are recorded at the amount of the cash or cash equivalents paid or the fair value of the consideration given to acquire them at the time of their acquisition. Liabilities are recorded at the amount of the proceeds received in the exchange for the obligation in some circumstances, for example, income taxes, at the amount of cash or cash equivalents expected to be paid to satisfy the liability in the normal course of business. B. Current cost. Assets are carried at the amount of cash or cash equivalent that would be paid if same or equivalent amount was acquired currently. Liabilities are carried at the undiscounted amount of cash or cash equivalents that would be required to settle the obligations currently. Realizable settlement value. Assets are carried at the amount of cash or cash equivalents that would currently be obtained by selling the asset in the orderly disposal. Assets are carried at the present discounted value of the future net cash inflows that the item is expected to generate in the normal course of business. Liabilities are carried at present discounted value of the future net cash outflows that are expected to be required to be settled the liability in the normal course of business. The measurement basis most commonly adopted by the entities in preparing their financial statements is historical cost. This is usually combined with the other measurement bases. For example, inventories are usually carried at the lower of the cost and net realizable value. Marketable securities may be carried at the marketable value and pension liabilities are carried at the present value. Furthermore, some entities use the current cost basis as a response to the inability of the historical cost accounting model to deal with the effects of the changing prices of non-monetary assets. Concepts of capital. A financial concept of a capital is accepted by most objects in organizing their financial statements. Under a financial perception of a capital, such as financed money or finance purchasing power, capital is identical with the net assets or the equity of the unit. Under a physical perception of capital, such as the operating competence, capital is viewed as the productive capacity of the article based upon, for instance, units of output per day. The collection of the appropriate perception of the capital by an entity should be created on the wants of the workers of its financial statements. Thus, a financial perception of a capital should be accepted if the users of the financial statements are mainly troubled with looking after of the nominal invested capital or the purchasing power of the invested capital. If, though, the foremost anxiety of the users is with the operating competence of the article, a physical perception of the capital should be used. The perception specifies the goal to be achieved in the defining point. However, there may be some dimension problems in the making of concept operational. Perception of the capital maintenance and the purpose of the profit capital maintenance. A. Financial capital look after. Under this perception, a profit is received only if the financial or the money quantity of the net assets at the end of the period go beyond the financial or money amount of net asset at the beginning of the period, after excluding any distributions to and assistance from holders through the period. Financial capital maintenance can be restrained in either insignificant monetary units or elements of the constant purchasing power. B. Physical capital preservation. Under this perception, a profit is received only if the physical productive capacity of the entity at the end of the period exceeds the physical productive capacity at the beginning of the period, after discounting any allocations to offering from owners during the period. Concept of capital throughout the low inflation and deflation. First, physical capital preservation, possible through low inflation and deflation. Current cost accounting perfect arranged by IFRS. Second, financial capital preservation in insignificant monetary units, historical cost accounting. Approved by IFRS but not arranged, voluntary throughout low inflation and deflation. Historical cost accounting. Financial capital preservation in insignificant monetary entities per se during inflation and deflation is a myth. It is incredible to uphold the real value of the financial capital perpetual with the dimension in the nominal financial unit per se during the inflation and deflation. Third, financial capital keep in units of the continual purchasing power. Capital maintenance in the units of the constant purchasing power accepted by IFRS but not certain, voluntary through low inflation and deflation. Capital maintenance in the units of the constant purchasing power is decided over hyperinflation in IAS 29. That is, the restatement of the historical cost or existing cost period and financial proclamation in terms of the period end once a month distributed consumer price index. Only financial capital maintenance in the units of the continual purchasing power, capital maintenance in the units of constant purchasing power in terms of day-to-day index per se can mechanically retain the real value of the financial capital continual at all stage of inflation and deflation in all objects that at least break even in actual value, ceteris paribus, for an unlimited period of time. This would occur whether these articles own a valuable fixed asset or not, and short of requisite of more money or extra reserve profit to merely retain the present constant real value of existing shareholders' equity constant. Financial capital maintenance in units of the constant purchasing power requires the calculation and accounting of net monetary losses and gains from holding monetary items during low inflation and deflation. The calculation and accounting of net monetary losses and gains during low inflation and deflation have thus been authorized in IFRS since 1989. The concept of capital maintenance is concerned with how an entity defines the capital that it seeks to maintain. It provides the linkage between the concept of capital and the concept of profit because it provides the point of reference by which profit is measured. It is a perquisite for distinguishing between an entity's return on the capital and its returns of the capital. Only inflows of assets in excess of amounts needed to maintain capital may be regarded as a profit and therefore as a return on capital. Hence, profit is the residual amount that remains after expenses including capital maintenance adjustment where appropriate have to deducted from income. If expenses exceed income, the residual amount is a loss. The physical capital maintenance concept requires the adoption of the current cost basis of measurement. The financial capital maintenance concept, however, does not require the use of a particular basis of measurement. Selection of the basis under the concept is dependent on the type of the financial capital that the entity is seeking to maintain. The principal difference between the two concepts of capital maintenance is the treatment of the effects of the changes in the price of assets and liabilities of the entity. In general terms, an entity has maintained its capital if it has a much capital at the end of the period as it had in the beginning of the period. Any amount over and above that required to maintain the capital at the beginning of the period is profit. Under the concept of the financial capital maintenance, where capital is defined in terms of the nominal monetary units, profit represents the increase in the nominal money capital over the period. Thus, rises in the prices of asset said over the period, usually stated as two allotment gains, are abstractly profits. They may not be recognized as such, though, till the assets are liable of in an interchange transaction. When the conception of the financial capital upkeep is defined in terms of the continuous purchasing power components, profit signifies the rise in the participated purchasing power over the period. Thus, only that portion of the rise in the price of the asset that go beyond the rise in the overall levels of prices is viewed as profit. The rest of the growth is treated as the capital preservation alteration and hence are part of equity. Under the perception of the physical capital maintenance, When capital is distinct in terms of the physical productive capacity, profit signifies the increase in that capital over the period. All price alteration disturbing the asset and liability of the entity are viewed as changes in the dimension of the physical productive capacity of the entity. Hence, they are treated as the capital maintenance adjustment that are part of equity and not as profit. The selection of the measurement basis and the concept of the capital maintenance will determine the accounting model used in the preparation of the financial statements. Different accounting models exhibit different degrees of the relevance and reliability, and as in other areas, management must seek a balance between the relevance and the reliability. This framework is applicable to a range of accounting models and provide guidance on the preparing and presenting the financial statements constructed under the chosen model. At the present time, it is not intention of the board of IASC to prescribe a particular model other than the exceptional circumstances, such as for those entities reporting in the currency of the hyperinflationary economy. This intention will, however, be reviewed in the light of the world developments. Requirement of IFRS. IFRS financial statements consist of IASI 8, a statement of financial position, a statement of comprehensive income separate statement, comprehensive and income statement, and distinctly a statement of the complete income, which settles profit or loss on the income statement to total complete income. A statement of changes in the equity, SOCE, a cash flow statement or a statement of cash flows, notes containing a summary of important accounting policies. Reasonable statistics is essential for the previous reporting period, IAS 1.36. An entity making IFRS accounts for first interval need to apply IFRS in full for current and qualified period, while there are transitional exemptions, IFRS 1.7. On 6th September 2007, the IASB issued a revised IAS 1 presentation of financial statements. The primary modification from the previous type are to include that an entity must present all non-owners alteration in equity, that is comprehensive income, either in one statement of the comprehensive income or in two statements, a distinct income proclamation and the proclamation of comprehensive income. Components of the complete income may not be obtainable in the statement of changes in the equity. Present a statement of the financial position, that is balance sheet, as at the establishment of the first proportional period in a whole set of the financial proclamation when the article applies the new standard. Present a proclamation of the cash flow. Make essential disclosure by the way of a note. The revised IAS 1 is effective for annual periods beginning on and after 1st January 2009. Summary. Current cost accounting under physical capital maintenance at all levels of inflation and deflation under the historical cost paradigm as well as the capital maintenance units of the constant purchasing power paradigm. Financial capital maintenance in the nominal monetary units, that is globally implemented historical cost accounting during low inflation and deflation only under the traditional historical cost paradigm. Financial capital maintenance in the units of the constant purchasing power, that is constant item purchasing power accounting CIPPA, in terms of a daily consumer price index or daily rate at all levels of inflation and deflation under the capital maintenance in the units of the capital purchasing power paradigm and constant purchasing power accounting CPPA during hyperinflation under the historical cost paradigm. IAS 29, requirements to record the financial statement by IFRS.